Okay, thank you very much, Nolan. And welcome, folks. There's close to 1,000 of you listening to this webinar. It's a pleasure to have you all here. And I'm going to run through the equity component of asset allocation together with Seleho, who's going to talk about a few shares. I think the bottom line is we're fairly bullish. Sorry, before I start, there have been a few people commenting that the slides are very small. We've checked with a lot of people. The majority seems to be fine. So perhaps if you could just check the setting on your own computer. But we'll keep an eye on that. Right, so let's talk through the equity world. I think following on from what Nolan had to say, where will the money be made? We've talked about fixed income. In the domestic space, we're actually fairly positive that the great conditions we've had for the last 6 months in local equity markets can be continued. At the moment, if you look at where something like platinum is now 10% of our market, resources is close to 30%. And if you combine that with NASPA, it's effectively about 50% of our market being driven by China. And we do think that the positivity in terms of economic growth and economic rebound in the globe is feeding through into emerging markets, and that's going to benefit China and by consequence South Africa. We also think the domestic South African equity Inc. shares are still fairly cheap, and they've got some potential to re-rate. From a global equity perspective, the market has done phenomenally well. Investors in our segregated portfolios have received 15% per annum in dollars for the last 5 years, which is quite astounding if you compare it to averages preceding that. In Nick's Global Equity Fund, which he's going to talk about, that's 23% per annum for the last 5 years. So the markets are extremely buoyant. As we're going to show you, it's really flying out there. Economies in developed markets are bouncing back incredibly strongly. But shares are pretty expensive. So we have got some caution with regards to valuations. We'd be quite cautious in terms of putting new money into markets. But the baseline view is that we're in a bull market. Bull markets always start to feel expensive, and they can feel expensive for some time. But some incredible earnings growth coming through, which is justifying the stance we've had on equities for some time. So we'd remain invested in markets, but with a bit of caution. We still think there's some value in the reopening shares. We think there's great value in big tech. In fact, the Facebooks and Alphabets of the world are almost cheaper than the market if you strip out their cash. And then there's some banks and pharma companies that are relatively cheap with improving prospects. So the shares that have kind of been left behind for quite some time, we think there is some catch-up to play. Importantly, the world is rebounding strongly. The brown lines here are the forecast GDP growth numbers from the International Monetary Fund, and importantly, sustained growth well after 2021. But we look at asset allocation and we try and do kind of prospective returns. I think there's a few key things and premises on which we operate, which we'd encourage people to follow. First and foremost, we look to make you money. Second of all, our core investment philosophy is to invest in shares or companies that compound their growth, and we like to buy those at reasonable prices. Then within that, we want a core of solid compounding companies, over time 10 to 20% exposure to emerging markets, and at times even more than that. I think if you look 10 to 20 years out, there's going to be 4 to 6% growth from emerging markets from a GDP perspective, and developed markets are going to slow down to probably around the 1% level. And then we think it's essential to have 25 to 50% exposure to technology shares or companies whose futures have been accelerated by technology. We really are in an unprecedented time. Nolan showed you the asset allocation. The bottom line is, from a local perspective, after about 14% year to date in local equity markets, we think if the global bull market continues, there's another 12 to 15%. From a global perspective, a little more cautious, and that's because valuations are significantly higher than South Africa. And everything, a lot of stuff, while it's doing very well, is priced for perfection. So any disappointments can be punished, but we probably would see that as an opportunity to pick up more equity. Just a reminder of how the markets have done year to date. So I've just circled there, the JSE All Share. And this is as of Friday, up 14%, and the S&P up 11%. We then spent a lot of time going through global and local company results. And I just pulled a few that really struck me over the course of the last few days. So, and consistent messages coming from CEOs about how strong the market is. about the fact that it's a coiled spring. And here we're talking about the economy and largely in the US. Unprecedented demand, a lot of pent-up demand. The CEO of Whirlpool saying that in all the years he's been doing the earnings call, this is probably the year that I'm most bullish about mid and long-term consumer demand trends. So people are not talking just about this year, they're talking about a multi-year boom from a consumer perspective. The Blackstone CIO talking about the economic dam starting to burst, and the head of Interactive Brokers referring to an absolutely spectacular quarter. So some very flowery words being used here for an economy that's, I think sitting in South Africa where things are pretty still tough, still pretty tough, and in a lot of emerging markets where we're kind of lagging from a vaccine point of view, it's going to take a lot of time to get back to these kind of numbers. Then this is the US. So as of Friday, we're about halfway through the first quarter US earnings season. And you can see here the blue line, the top line, is all securities. So the market earnings growth is sitting at 54% compared to the first quarter of last year. Now, obviously, importantly, things started to slow down at the end of the first quarter of last year. So you would expect some pretty dramatic growth. But if you go down to the line where it says surprise in the second block, the earnings surprise is 25%. In other words, for the companies that have announced year to date, for the first quarter, the expectation was for 25% earnings growth, and it's come through at 53%. And that's the key reason why the market has remained strong, and we're still on the positive side of the bullish line. Just a few that struck me, which are worth kicking out. Anything to do with luxury goods or people spending money in their kind of rebound and the pent-up demand is absolutely flown. So some phenomenal numbers here from LVMH, that's Louis Vuitton, it's Veuve Clicquot, wines and spirits, fashion and leather goods. The numbers that I've circled there, the change for the last numbers against a year ago, we're up 36% for wines and spirits, 52% for luxury goods. Now you might say that's just off a low base. So we went back another year. So the first quarter of 2021 compared to the first quarter of 2019, and still 17 and 37% growth. So all that pent-up demand, the stimulus that's flowed through into the economy is resulting in people spending in something of a frenzy. One of the reasons is the vaccine story is a very good one. Developed markets have been very good at getting the vaccine into people. And once the vaccine's in people, it's been very effective at slowing transmission and vastly reducing deaths. Israel is the one I like to look at closely because they're close to fully vaccinated from an adult perspective, and they're down to literally 10 to 20 cases a day. So the vaccine is working. In the US, they're pretty much going to be done by somewhere between July and August, depending on how you on what you consider done. But developed markets, we are seeing the positive news come through, and stuff has been positive at the margin with some small negative blood clot issues in terms of numbers, but we're quite positive on this and all kicking through. However, we don't know what the future holds. There can be some negative surprises. There's been less than we expected, and that's why we are expressing some caution. This is the numbers that we do in terms of earnings growth around the world and forward PE multiples. And here what we want to show you is even if you bring into account the pretty strong earnings numbers, valuations are pretty expensive. So world earnings growth this year is expected to be about 48% and then 12% next year. The 48%, obviously a lot of it is recovery from a low base set last year in some industries. That takes you to a forward PE 1 and 2 years out of 19 and 17, which by historical terms is quite expensive. We think there's reasons for it to be trading at a premium, but there's also when markets are trading at a 30% premium on a forward basis, there is a room for a pullback at some stage. Interestingly, you'll see in the emerging market index, 12% growth this year and 21% the following year. And what that really is showing that emerging market growth is going to take another 6 to 12 months longer than developed markets. They're not fully vaccinated. The economies will be under pressure for a longer time period. So this is the MSCI World Forward PE multiple. And you can see that the red line is the average over time, which is about 16. and we're sitting now in around the 17 to 19 mark. So companies are pretty expensive, and one has to be very selective. We then get, it's hell of interesting to see the differences in valuations. And what I'm endeavoring to show you here is the big tech companies where there's some fear about antitrust and the like. Facebook came out with results the other day, absolutely phenomenal numbers. One of the biggest companies in the world grew its turnover by 50% and its profits by 100%. Yet quite modestly valued. If we go down the line here, Facebook, this is in the quarter, ended March, $25 billion of revenue. They made $11 billion of profit in one quarter. If you multiply that by 4, you get to a P multiple of about 22%. Importantly, and I think what people fail to realize with these big tech companies is massive research and development expenditure. So they spend $5 billion, and they'll probably spend $25 billion this year on inventing the future, on AI and all the technology solutions that we haven't even thought about. So, we think a company like that is very attractively priced. By contrast, you get a company like Tesla, and Nick will talk about it in his presentation. Nick is very focused on high growth companies, and Tesla is no doubt that. So I won't go into too much detail. But this is just to show you how the market is prepared to place an aggressive forward valuation on a business that's really yet to deliver a bottom line. So by contrast to Facebook, about $10 billion of revenue, just making a little bit of income, and it's got a valuation up at about $700 billion. There was a point earlier on in the year when Facebook and Tesla had similar valuations. So that doesn't mean the companies are sell. In fact, Nick is extremely bullish on it. It's one of his top shares. But just to indicate across the market, there's different valuation opportunities depending on where you want to sit on the risk-return curve. And then I couldn't help myself but put Bitcoin in, which basically has no revenue, no income, and a market cap of 1.1 trillion. The S&P itself, earnings are strong. So what this endeavors to show, if you look at the dotted line, the long-term trend will in fact be exceeded once earnings bounce back in 21 and 22. So this is our expectation for global equities over 12 months is about 5%. And the chart on the left-hand side shows the range of potential outcomes, where we think there could be another 10, maybe even 20% in global markets if everything goes well. But there's also more downside. If there is a second or a third wave and there's a shock that we haven't anticipated, there's every prospect of a 15 to 20% drawdown in markets. And one has to go into it realizing that those are the risks. I'm now going to ask Seleho to talk through Netflix for us, which we think is a very interesting opportunity.
Thanks, Pete. Yes, so Netflix is really all about scale. That's kind of their competitive advantage. And you see that if you look at these two graphs that we have on the slide. So on the left, we have Netflix's content budget compared to the major media companies of the US. You can see that Netflix, in terms of pure entertainment budget, outspends its peers. But then what's really interesting is if you look on the table on the right, you have some of the major streaming services coming out of these media companies. And Netflix is comfortably in the lead in terms of subscriber numbers. So we think that on a per subscriber basis, what's very unique about Netflix is it's actually able to spend less on a per subscriber basis than its peers. And so it really comes down to these economies of scale. Even though it's outspending on an absolute basis, we think over time it'll be able to underspend competitors on a per subscriber basis in terms of its content budget. What's also attractive about Netflix is it has quite a long runway for growth. You can see that in the addressable market. Sorry, Pete, could you go back to the, you can see that in the addressable market. So Netflix today has roughly 200 million subscribers, just over that. And they've cited an addressable market of what they believe is between 800 million to 1 billion pay TV households outside of China. So that's the market that they're trying to address over the long term. Over the past few years, they've been adding between 20 to 30 million subscribers per year. Because of the pandemic last year, they added about 37 million subscribers. This year, there's a bit of, I suppose, indigestion in the sense that as lockdowns start to abate and people start to go out more, it's going to be a challenge for near-term growth. So we do think that there's a challenge in terms of near-term growth for Netflix, as people are going to be a bit tired in the second half of 2021 of staying indoors and not living life as we used to pre-pandemic. But we do think over the long term that they'll still have the ability to add 20 to 30 million plus subscribers per year, and to really be the leader of the OTT, the online streaming market. So we think the runway for growth for Netflix continues to be very attractive, even though we do think in the short term, there's going to be a challenge as lockdowns start to ease globally. If we go to the next slide, one of the fundamental criticisms of Netflix, and it has been a concern that you can make, or previously you could make, is that this business didn't generate cash. It was burning cash. So especially as they looked to increase their original content spend, Netflix was increasingly burning cash. And that really peaked in 2019. Last year, they generated over $2 billion of free cash flow, which was quite a surprise to the market. That was helped by the fact that because of the pandemic, they weren't able to spend as much on content as they had anticipated. So their content spend was artificially low in 2020. But what's really interesting about Netflix now is that at the end of 2020, they guided that they believe they're going to be free cash flow break even in 2021. And then after this year, after 2021, they're guiding for the business to actually be free cash flow positive. So this has huge implications for the business and the share, in the sense that it means the balance sheet is no longer going to be under the pressure that it has potentially, it could have come under. And they should be generating cash and really either reinvesting that cash back into the business or doing things like dividends and buybacks. And they have talked about starting a buyback program. So we think that this is now a business that's in quite an interesting space. It's quite an interesting setup in the sense that they should be able to grow revenues over the long term at 20% plus if things go right and they can address that large addressable market. We think that free cash flows could grow faster than that as free cash flows start to ramp up from a break-even level in 2020 and 2021. And then what's really interesting is that if you assume a margin of about 25%, the shares at a multiple of between roughly 33 to 35 times, depending on the assumptions that you use. So we think that shareholders in Netflix should be able to earn a return that is quite close to that growth rate of 20% plus. And we think that's quite attractive given the competitive advantages that we touched on in the earlier slide. So this is a business that we find quite attractive.
Thanks, Seleho. We'll invite you back to talk about one or two South African shares. So we do have in our investment approach a core philosophy of being in growth shares. But one of the things we like to do in our business is help people identify shorter term kind of trading opportunities or tactical opportunities, we call them. And something we've been showing our clients and guys have made a lot of money out of over the course of the last 12 or 18 months is what we call our tactical portfolio, where we bought companies which might not necessarily fit into our classic definition of a compounding business, but companies where we think their share prices have got big opportunity to rise. So we've had this recovery or tactical portfolio running since about April last year. It's delivered a return roughly double of the market, but we still think there's opportunities. And in fact, on this slide, I'm not going to go through in any detail because of time limitations, but we're happy to share it with you as clients. But the potential upside that we still see from these counters, if you look at the blue graphs, we think some big upside still in a lot of companies. And this portfolio, if it reached its potential, could deliver 36% over the course of the next 12 months. So we're always trying to find the next place in the market where there's money to be made. From a JSE perspective, I've talked largely about the globe. And South Africa fits quite squarely into that. The South African market is being led by global factors at the moment, a gradually improving global growth outlook. There's high yields, So currency strength, our trade balance, because the economy is quite weak, ironically, you're having a lot of exports of things like platinum, but not much coming in. So a pretty strong currency. It encourages people to invest in the country, and emerging market equity outperformance. So some of the themes that are playing out in the JSE, our equity fund has done about 15% year to date. So it's been a great place to be. And we still think if the world is in a good place and continues to deliver what we've seen so far, that the metals and materials can continue to do well if commodity prices hold. Our shares are pretty cheap. Cyclical recovery from the domestics, our banks, retail, property and insurance companies. So some exposure to the SA market is certainly warranted. The SA market, if it does really well, we think you could be up at 25%. And if you remember in global markets, we said if things didn't go well, you could go down 20. We think the risks on the SA market this time around are lower because our valuations are much lower and the currency is pretty strong. So if things did go a little awry globally and the markets came off, you would certainly see the rand weaken a bit from these levels. We think some of the commodity shares look pretty interesting. So again, we've asked Seleho to talk through one or two. Hand it over to you, Seleho.
Thanks, Pete. There's been a lot of attention on platinum, the PGM sector on the JSE over the past few years. And the graph on the right-hand side really illustrates why. Essentially, the basket price has driven these shares higher. You can see it's done phenomenally well over the past couple of years in rand terms. We think that Northam Platinum is a very unique and interesting story within the space. So if you look at the graph on the left, it shows Northam Platinum's production at the moment, which is roughly 500,000 ounces, and what they intend to get it to, which is about 1 million ounces over the medium term. But if we just take a step back and look at platinum from a bit of a bird's eye view, what's interesting about this sector is that you have the potential, it doesn't always come through, but you have the potential for cycles to be relatively long because it takes 7 years at a minimum for new supply to come on from the time of announcement for a project to when you actually start producing from that asset. And so supply in the short term can be relatively inelastic and difficult to ramp up for these producers in response to higher prices. And then also in addition to that, last year, because of the pandemic, it was quite difficult for these companies to produce. So their supply was also artificially restricted because of that. And then on the demand side, demand is probably the bigger question. So that's a lot more tied to global GDP, car sales, and jewelry. And it's been helped over the past few years by emissions regulations. But really, you have a question of how sustainable this demand is given the inelasticity of supply in the short term. Now, why we've singled out Northam in particular is the volume growth story that they have over the next couple of years. Northam's very unique in the sense that at the bottom of the cycle or during the downturn in PGMs, when their peers, the rest of the industry was really pulling back on production, Northam, despite being under pressure in terms of their cash flows and balance sheets, made the decision to invest through the cycle. So they took a bit more of a longer term view with the conviction that the prices would rebound. And they're now in a position where they've done so the capex has been made. They've spent the money on this capex, and it's really just about executing on this ramp up in production. So going from about 500,000 ounces of PGMs to 1 million over the next, we estimate 4 to 5 years. And so this is really unique within the PGM space. If you look at some of their peers, such as Implats, for example, or Amplats, you don't have this kind of growth from a major PGM company. Because of this, Northam today is on roughly a 5 times run rate earnings multiple. And we think that could unwind quite quickly if they're able to execute on this volume growth story and if prices hold. If you go to the next slide, Pete. We have another commodity-focused company. So this is Anglo American. Now, what's different about Anglo in comparison to Northam is that this is a more diversified portfolio of commodities. So whereas Northam is 100% PGMs, Anglo American is much more diversified. They've got copper, iron ore, palladium, coal, diamonds, etc. So you're not betting on one commodity, although you are obviously betting on the commodity sector as a whole. But what's interesting about Anglo American, and you see it in a few other companies in this sector, is that their portfolio of commodities is in quite a sweet spot in terms of the exposure. So copper, for example, is at a 10-year high. Iron ore, which we are a bit more cautious on, is at a 10-year high. Palladium's reached all-time highs. So several of the commodities within their portfolio are seeing quite a bit of pricing strength at the moment. What's interesting about Anglo American as a company, if we drill down to it specifically, is that they're actually growing volumes in some of these commodities at quite a nice time. So similar to Northern Platinum, a few years ago they really laid down the groundwork for some of these projects. For example, Quellaveco, which is quite a big copper project. It's going to grow their volumes by just under 20% starting from next year. And that's quite unique, particularly within the JSE. It's quite a unique exposure that you don't really get from many of the other diversified mining companies. The share at the moment is trading at about 5 times earnings, which we would expect. So I wouldn't say that's what attracts us to the share in particular, because we would expect the multiple to be low at a time when commodity prices are high. But what's interesting about Anglo American, and you could say the sector as a whole, or some other companies in the sector, is that at the current run rate of cash that they're generating, it's likely that they're going to have net cash by the end of the year or close to it. And so we think they'll have the ability to get a bit more aggressive on cash returns to shareholders. So that's dividends and buybacks. And really it's going to get to a point where if you had let's say a 4 or 5 times multiple with a very aggressive cash return profile to shareholders, it can look quite attractive, even if we do acknowledge that these are cyclical companies and we wouldn't want to, for example, price iron ore at $190 in perpetuity. But it is quite attractive. And that's really the story.
Thanks, Seleho. So that's it, guys. We've taken you on a little trip around the equity world. Just a reminder of where we think the money will be made. In domestic equities, we think emerging markets in South Africa will be a beneficiary of the global risk on investor mood. Chinese economic strength will benefit our market, with roughly 50% of the JSE driven now by China ultimately. And the domestic SA shares are fairly cheap and have the potential to re-rate. From a global equity perspective, we think it's increasingly about share selection as indexes hit all-time highs. You don't want to own all of these businesses at high valuations, but there's still some value in some reopening shares. There's some great value in big tech. We've showed you something like a Facebook is actually cheaper than the market, and it's still growing at phenomenal growth rates. And some value in the banks and pharma companies, which are relatively cheap with improving prospects.